Welcome back to Talk Tickers. Today, we are wading into some pretty controversial waters to talk about one of Wall Street's most debated practices, naked short selling. So, is it a financial weapon of mass destruction used to kill companies, or is it a crucial, maybe even misunderstood, tool for keeping the market efficient? It's a topic that gets people really fired up, so let's break it down.
And just to set the stage for how high the stakes are, listen to this quote from a former Undersecretary of Commerce. He's not mincing words. He believes companies were literally destroyed by this practice. And this isn't some fringe idea. Naked shorting has been tied to huge market events, like the 2008 financial crisis. So yeah, this is serious stuff.
All right, before we get into the whole conspiracy and controversy side of things, we've got to get the basics down first. How in the world can you sell something you don't even own? Let's start with a normal, totally above-board short sale.
Okay, so a regular short sale is actually pretty simple when you break it down. Imagine you think a stock, trading at $60, is about to tank. What do? Well, you borrow some shares from someone who owns them, and you immediately sell those shares for $60 each. Now you wait. If you're right and the stock drops to $40, you then buy back the same number of shares at that new, lower price. You return the shares to the person you borrowed them from, and you get to keep the $20 difference for every share. That's your profit. This is called a covered short sale because you actually had the shares, you covered your bases before you sold.
Now, here's where things get sketchy. With naked short selling, you do the same thing, but you skip a huge step. You sell shares you haven't actually borrowed yet. You're basically selling an IOU, a promise of a share. And this can lead to a big problem called a failure to deliver, or FTD. That means when it's time for the transaction to settle, when the buyer is supposed to get their shares, you might not have them to give. And that creates a ton of uncertainty.
So let's just put it side by side, because this is the absolute heart of the matter. Covered shorting. You borrow before you sell. It's a legitimate, everyday market practice. Naked shorting. You sell without borrowing first. This is where all the controversy, all the regulation, and all the accusations of abuse come from. It's that one simple difference, and it changes everything.
So you can probably see where this is going. How does this one little trick lead to accusations of a massive Wall Street conspiracy? Well, let's dive into the case against naked short selling.
And you might be sitting there thinking, okay, so what's the big deal? If the seller eventually finds the shares, who gets hurt? Well, according to the critics, the potential for damage here is absolutely massive.
Here are the accusations. Critics say that naked shorting creates phantom or counterfeit shares out of thin air. This flood of non-existent shares can dilute the value for actual shareholders and artificially drive a stock's price into the ground. They argue it's a predatory tactic, often used to attack smaller, more vulnerable companies. And it gets worse. By crushing a company's stock, it can cut them off from traditional funding and force them into what's called death spiral financing. Toxic deals, often with the very funds that are shorting them into oblivion.
You know, blaming short sellers when things go bad is a tradition as old as Wall Street itself. I mean, look at this. It's a recurring theme. All the way back in 1772 with the East India Company, fast forward to the Great Crash of 1929, then to Lehman Brothers in 2008, and of course the whole GameStop saga in 2021 that brought this debate right back into the mainstream. Whenever there's a crisis, short sellers often get painted as the villains. Given all that history, it's pretty easy to see why naked shorting has such a terrible reputation. But is that the whole story? Is it really just a tool for bad actors? Well, believe it or not, some really interesting academic research suggests there is a completely different side to this coin.
Get this. A major academic study from 2014 basically said, hold on a minute. The researchers were pretty blunt about it. Their findings, based on hard data, were in sharp contrast with what pretty much everyone in the media and even regulators seem to believe about naked shorting. And this is where the plot really thickens.
So what did they find? The results are, well, kind of shocking. The study discovered that a small increase in naked shorting was actually correlated with signs of a healthier market. For instance, the bid-ask spread, which is basically the fee you pay to trade a stock, it went down. And volatility, how wildly the price swings around, it dropped by a massive 37%. It's the exact opposite of what you'd expect.
So, what does all this mean in plain English? Well, it suggests that naked shorting might actually be good for the market sometimes. It can add liquidity, making it easier to buy and sell stocks that don't trade very often. It can also help correct prices when a stock is way overvalued. And market makers, the folks who facilitate all the trading, they argue they need this flexibility to keep markets from seizing up, especially when things are moving super fast.
Okay, so we have two completely opposite stories. On one hand, it's a destructive conspiracy to bankrupt companies. On the other, it's a useful tool that makes markets run better. So what of the regulators, the referees in all this, done to try and solve this puzzle?
Their main answer came in the form of something called Regulation SHO. The SEC rolled this out back in 2005 and then made it even tougher after the 2008 meltdown. The whole idea behind Reg SHO was to crack down on the abusive, predatory forms of naked shorting without totally outlawing the practices that market makers said were necessary.
So Reg SHO has a few core pillars. First, there's the locate rule. This says a broker has to have a pretty good reason to believe they can actually find the shares to borrow before they let a client make the short sale. Then there's the closeout rule, which says you can't just fail to deliver shares forever, you have to fix the problem quickly. And finally, a clear anti-fraud rule makes it totally illegal to lie about having located shares when you know you haven't.
So, where does that leave us? Market menace or misunderstood mechanism? Honestly, the answer seems to be it's complicated. The real problem might not be short selling itself, but how easily it can be abused. And while regulators have definitely clamped down, the debate is a long way from being settled. It leaves us with a pretty big question for the future. As our markets get faster, more digital, and more complex, can the rules of the game ever truly keep up? This is not financial advice.